It's Brian Preston, the money guy.
All right, in the last kind of special withdrawal provision, and we've done shows on this in the past as well, are 401k loans. Now, you may think this sounds amazing because I have an opportunity. I can actually borrow money from myself. I can pay myself back. I can make the interest. This seems like the best idea in the world. Brian, are 401k loans an amazing idea for someone to utilize in their financial plan?
Well, it does. I mean, on paper, I always say the brochure looks outstanding on this because you feel like, hey, I have this big pot of assets. I can go borrow from it. I will pay myself back. I'm essentially playing the part of the bank here.
Yep.
But we're forgetting there's a huge component here called opportunity cost because a lot of these 401k plans that allow you to do these loans do not allow you to make new contributions while you have an outstanding loan.
Right.
They also will keep out, a lot of times they give even the employer funding, the match, and those type of things is excluded while you're in this. It's a penalty in a lot of ways. And we created a case study to show you what this opportunity cost could be costing you if you didn't know all the things, the blind spots that are working in the background.
So let's assume you have two coworkers, Clark and Eddie, both age 35, and they've accumulated $100,000 in their respective 401k plans. Let's say that they each make $50,000 a year, and they decide to put 15% of their salary, which equals about $625 a month, and receive a 3% employer match. That's sort of the baseline. However, Clark decides he wants to take out a 401k loan of $35,000 at a 4% interest rate to build a pool for his family. He wants to go create memories. So after building the pool, Clark has $35,000 less invested in his 401k than Eddie. He has $65,000 invested. Eddie has $100,000 invested. For the next 5 years, Clark pays $645 per month until the loan is paid off because he has to pay it off inside of 5 years. Eddie, however, keeps contributing 15% and getting the match in his 401k. Clark, because he has an outstanding 401k loan that he's paying back, is unable to make new contributions, and he also forgoes the employer match because he has the 401k loan outstanding. Well, after paying off his 401k loan, Clark's balance is now nearly $145,000. So he has the $65,000 plus he paid back the loan plus interest plus earnings on the $65,000. Eddie, however, after 5 years, has nearly $60,000 more in his 401k. So Clark has $144,000 with a pool. Eddie has $204,000.
So on the cusp of this, just 5 years into it, we see how there's a $60,000 difference. You're probably thinking, yeah, but that's okay because we also now have the memories. We have this pool in the backyard. That sounds great. But remember, there's a reason I have this koozie that says this $1 beer cost me $88. Mm-hmm. It's because compounding growth, the eighth wonder of the world, is exponential.
Yep.
And so that $60,000 difference is not done. Guess what? It could have been working in the background. Bo, what does this actually mean by the time that Clark and Eddie retire?
Yeah, so if after this 5-year period, they both start contributing 15% again because they're both hyper savers, they want to be financial mutants, and they do that for 25 more years. By retirement, Clark would have about $1.77 million in his 401k. Eddie, however, would have a little over $2.2 million. In other words, you could say that Clark's $35,000 pool loan cost him nearly $450,000 in retirement from just 5 years of contributions and employer match. That is how costly that decision can be for taking soldiers out of your army of dollar bills.
We covered this in great detail. We had an Ask the Money Guy episode titled, Should You Take Out a 401k loan? But really what we're talking about, if you look at the next slide, what this is really hitting on is I love giving this, the younger you start saving, a lot of people are shocked. If I was talking about how much you'd have to save per month to be a millionaire, you're surprised to find out for a 20-something or 20-year-old, it's $95 a month.
Yep.
But when you do the math on it, you go, wait a minute, $95 a month for a 20-year-old, by the time they retire at 65 is going to be worth $1 million. That's crazy, because if I do the math on that, they've only put in $51,000. So how does $51,000 turn into $1 million? It's because close to $950,000 of the $1 million is actually the growth, exponential growth. So imagine that $35,000 pool that when we did Clark and Eddie, because we all know Clark Griswold built the pool, but instead he got the jelly of the month or whatever it was. This is what I think a lot of people don't understand. In their mind, they compartmentalize, hey, I'm making a $35,000 decision. That's because it's not just pools. How many people leave an employer and then go and buy a new car instead of rolling the money to let it keep working, they go buy a car, they buy the swimming pool. I'm telling you, you don't know which dollars you're taking. You're taking those dollars that exponentially could be so much larger. And a lot of you are saying, well, okay, that's a 20-year-old. That makes sense. It's 45 years of growth. Guys, this applies also to the 30-something too, because look at the 30-year-old, still 89% of your account, if you were putting in $270 a month, that only totals for 35 years $113,000. That means the other $887,000, or 89% of the account, is coming directly from the growth of the account, not your contribution. But you got to give the money the time to work. Even for 40-year-olds, you're going to put in $780 a month, or $234,000 over that 25-year period. Still, $766,000, or 77% of your $1 million is going to come from your army of dollars compounding over the years. Do not take your army of dollars off the field while they're still in their most impactful period of time and getting that compounding growth opportunity.
I think that's the big takeaway, is you want your soldiers working for you, so you don't want to take them out of the game. Yes, there are special withdrawal provisions that exist inside your 401k, but just because you can doesn't mean you should.